If you are buying a call options and price is moving, the option also will move. Though the market is going up, but it is not going up in the speed you want. You have an expiry, okay? So then you will make a loss here. So 90% of the time, it is good for seller. So thus, 80% of the time, you are going to lose the money. 50% of the time, market stays either in low volatility or high volatility. Yeah. Your view is right, but the market is not going to this strike price on time. So the time decay will kill you. And generally people don't buy this, okay? And my case in intraday, I buy item option for a simple reason. Here the volatility is also less. And you may ask a question, but the view is wrong, you're going to make loss now. The Correct. View is wrong, I am okay to make loss. But I don't want to make a loss based on the volatility as well as the theta.
All right, another day, another learning video on Upsurge with me, Ansh R. Hiran. And on a very popular demand, we have IT Jegan sir with us again. Hi, sir, welcome back to Upsurge.
Yeah.
So we were just having a discussion over here and you said, okay, we can do option buying without the premium decay, right? So you were explaining a little bit about it. I just want you to explain this to all our viewers, how we can actually do option buying without the premium decay.
Sure.
So stage is all yours, sir.
Yeah, okay, thank you. Generally, right, so most of the retail people, they will come to the option buying for two reasons. Reason number one is actually the limited capital. Reason number two is actually the unlimited profit, unlimited loss. Okay, so but as many retail people think, problem with the option buying is actually, so options will have multiple factors. Okay, so factor one, the price.
Correct.
Okay, so when the price moves, the option also will move. Okay, say for example, if you are buying a call options and price is moving, the option also will move. Right. So first factor is the price. Okay, second factor is the volatility. Okay, and third factor is the time decay. Fourth factor is interest rate.
Correct.
Okay, and this interest rate is not going to change much, so let's not discuss this because the interest rate, it may be 6 to 5% or 6 to 7%, so it is changing like this. Let's not discuss this. Okay, and price. Okay, so you have to be right to make a profit in a option buying, right? So you say, for example, if market is going up, you will be buying call option. If market is going down, you will be buying the put option.
Correct.
Right. So you have to be right. So let's assume that you are in the right direction. So this is also your right. Okay, assume that actually you are okay to make a profit when the view is right, and you are okay to make loss when the view is wrong. Okay, right. But these are the two factors that is going to affect you in option buying. Okay, and the time decay, I mean, though the market is going up, but it is not going up in the speed you want. You have an expiry. Okay, so then you will make a loss here. Example, let me take an example. Say for example, your price is 1000. Okay, and you are buying option 1100. Market went up to 1050. Okay, you bought 1100 call, still you are going to make loss. Yeah. Your view is right, but the market is not going to this strike price on time. So the time decay will kill you. Second factor is the volatility. Okay, so the volatility, say for example, you bought this option. Okay, and say for example, market is 1000 and you bought 1020 call option. Okay, the price was 100. The price was 100. Okay, yeah. And market went up 1110, but volatility came down. So this 100 rupees will come to 60.
Correct.
Because the volatility is coming down. So there are two major factors that is affecting the option buying. That is the volatility and time decay. Okay. So option buying, you can do it in three ways, three types, right? So one is the OTM option. Right?
Correct.
And ATM option and ITM option.
Right.
Right. So you can see this option. And in general, IV is very, very moderate here. Okay. IV is moderate here. Very reasonable. The IB will be very high here. The IV will be very high here. Okay, I'm talking with respect to the IV right now. So there are two factors that is going to affect the option buy. One is a volatility, another is a time decay. The people who are buying this option, mostly they are buying the
OTMs.
OTM option. Okay,
Because they're cheaper.
Because they are cheaper, and it is affected by two factors, as I said, actually volatility as well as the time decay. Time decay. So the decay is very, very high. Okay, the amount of decay may be less, but in terms of percentage, the decay is very, very fast. So thus 80% of the time you are going to lose the money. Lose the money. Because you are against many things. People think that actually there is a 50% probability that probability that the volatility will increase. There is a 50% probability that actually the volatility will decrease. Okay, so when volatility is increasing, you will make a profit in option buying. When volatility is decreasing, you will make the loss. But in reality, it is not the case. I'll tell you the four corner cases how the volatility will behave in a market. So right now, let me tell me the four cases. Okay. So volatility is high, is there. Okay. So volatility is high is a one corner case. Okay.
Okay.
And volatility is low. It is sustaining in low volatility. This is the second case. Third case is high volatility to market coming to the low volatility.
Okay.
Okay. So this is the case. Okay. This is the third case. And fourth case is market from low volatility to high it is going. Okay.
Okay.
And 50% of the time market stays either in low volatility or high volatility. For the time being, if you look at this one, this market is in low volatility. And almost 40% of the time market is in from high volatilities to low volatilities is coming.
Okay.
Okay. Only 10% of the time it is going from
Low to
volatility to the high volatility, only 10% of the time. So thus, 90% of the time it is good for seller.
Okay.
Only 10% of the time it is good for buyer. And this buying is mainly happened only during the mega event. So 90% of the time the option buyer is against the volatility. Only 10% of the time it is favoring to the option buyer, and that too only in the mega event. That is the reason why volatility is also playing a major role. Okay. So if you have to arrest something, actually we have to do something for volatility as well as a time decay. So two factors, as I said, volatility as well as a time decay. Okay.
Correct.
And one more thing, this thing, and if you look at the option buying, okay, option buying, as I said, OTM, ATM, and ITM. Okay. So here the decay is very high. Here the decay is moderate. Here, since you are playing with in the money option, the decay is low. Okay. So most of the cases, people wanted to buy this OTM option because it's cheaper, and moderate, some people will buy. Yeah. Because it's little costly. And here, if you buy, the decay is less, but the problem is actually, if your view is wrong, you are going to make a big loss.
Big loss.
And generally, people don't buy this. Okay. And my case, in intraday, I buy ITM option for a simple reason. Here, the volatility is also less, and theta is also less. Okay. And you may ask a question, but the view is wrong, you're going to make loss now. The Correct. View is wrong, I am okay to make loss. But I don't want to make a loss based on the volatility as well as the theta. Okay. So if you have to buy the options, either you have to buy the ATM or you have to buy the ITM. And you may reduce the volume. So if the risk is high, you may reduce the volume. But don't go for a OTM option. OTM option is almost like a lottery. Now the question is, okay, we have decided that actually we will buy these ITM options. We will not buy the OTM or ATM option. Correct. Okay, but still there is a decay. Though we have decided that actually we are not going to buy OTM and as well as the ATM and ITM, but the decay is there in ITM, and volatility is also going to play a less role. Okay, there is a damage, but the damage is less. Okay. Correct. Okay, so the decay will be less and the volatility is less. Okay, so now, so we are going to look at the option. How do we arrest this one? Okay, so being an option buyer, you are against the volatility and decay, and option seller, you are there are three things that is favoring you: the price, as well as the time decay, as well as the volatility. This is
Correct.
favoring you. So right now we are going to see whether something we can mix with the option buying and selling, and then we can do we can arrest this one. So that is what we are going to see. Okay. So to arrest this one, we are going to do spread. Okay. So what is spread? The spread is nothing but if you are buying any option and selling the same call option. Okay. Buying call, selling call, it may be a different strike price or different expiry. This said to be spread.
Right.
Okay. Okay. And this you can do with the put as well. So say for example, buying a put option and you are selling some put option, then it is said to be a spread. Okay.
Correct.
Okay. And what is the advantage of spread is, so it is giving the advantage of buying as well as selling, because buying will have a limited loss and unlimited profit. Selling will have a limited profit and unlimited loss.
Correct.
But if you do a spread, combination of buy and sell together, you will have a limited profit and limited loss. So thus your psychology will not get disturbed. Number one, you don't get unlimited profit, unlimited loss. There is no unlimited profit, there is no unlimited loss as well. So the psychology is not disturbed. Second thing is the margin is less.
Yeah.
Because we are giving this margin benefit as well. So if you are selling naked option now, right now with index it is a 3L, and if you do it as the spread, what I am saying actually, you can do with 1L.
Correct.
Okay. So we decided that actually we are going to a spread. So now we have two types of spread in general. Okay. So I'm going to say about this spread. So the spread is actually, that is called credit spread. And one more thing is called debit spread. Okay. Debit spread. What is credit spread is, generally credit spread you can think like a option seller. Okay. So say for example, if you are selling a naked option, sell call, and you are buying maybe 2 strike price away, 3 strike price away, buying a call. Okay. So selling option for higher premium, say for example 100 rupees, and buying option for 50 rupees, and in the end actually you are getting a credit of 50 rupees.
Right.
Right. So since you are having a credit, so it is said to be a credit spread. Okay. So selling option for higher and buying option for lower, and in the end actually you are receiving a credit, it is said to be a credit spread. Okay. And this is generally it is called as a selling strategy. Selling strategy, or else you can say option selling with a hedge.
Correct.
Option selling with a hedge. And debit spread is ulta. Okay. So you are buying option, call option for 100 rupees and selling option for 50 rupees. So here the net debit is 50.
Right.
Okay. So this is said to be a debit spread. Okay.
Right.
So debit spread, and this debit spread, it can be done in intraday, it can be done in a positional. Okay. So I had given us exclusively debit spread strategy in Upsurge for positional for overnight. So how to do this debit spread overnight, especially for weekends. So how do you position this spread? So what time to enter, what time to exit? Okay. So what is the position size say you need to do with the exact backtesting? So you go and enroll this course in Upsurge. You will come to know how efficiently you have to do this debit spread for overnight. So you will learn it. Okay. So this is the one of the debit spread I am going to explain right now. For any case, it can be done in intraday or it can be done in a positional way. So now you understand what is positional, what is a debit spread, right?
Correct.
So this debit spread can be done in anything. Okay. So let's not discuss the credit spread right now. We are going to discuss the debit spread. Okay. So this, let's understand this. This is the adimony. Okay. So this is OTM call. This is ITM call.
Right.
Correct na? And this is ATM call. Okay. Now generally what we do, what the people do, generally they will buy ITM call, ATM call. Okay. And they will sell maybe 2 strike price or 3 strike price call. This is called people generally, this is OTM debit spread.
Yeah.
Okay. OTM debit spread. Okay. Generally, or some people will do the buy here and sell here. This is called ITM debit spread. Okay. But if you need to do a, if you want to do a option buy, so option debit spread is considered as a buy strategy because you have a debit.
Right.
Buying will have a debit and selling will have a credit.
Okay? You are buying heavy position. That's why.
Correct. You are buying a heavy position. So it is considered as this one. Okay. So now we are going to buy this option ITM call. We are going to sell OTM option. Okay. This one. So it is going to be middle. Okay. Buy here, sell here.
So wider spread.
It may not be wider. It can be tighter as well.
Okay.
Okay. So it can be tighter as well. It is not a big deal at all. If you are looking for a big target, you have to do the bigger one. If you are looking for a smaller target, you have to do this one.
Okay.
It's a simple one. Okay. So, but the question is, people will think that actually, okay, now we understood that actually we have to do this ITM and OTM options. So how do we do? Okay. So generally a plain vanilla option buyer will do, okay, 200 price, strike price in the money. Let's buy a call option. Correct na? This is ITM. And you are buying 200 away. Sell call options OTM. So the problem is here you will have a time decay is against you.
Correct.
Volatility is against you.
Yes.
Here you have a time decay is with you. Volatility is with you.
Right.
Both will be compensated.
And secondly, since we are buying the ITM, even though it's against us, it's less powerful.
Less powerful, and by the same thing will be compensated by here. That is the thought process. Okay, but this is okay. Ideologically, this is okay. But the thing is, we never know what is the volatility of exact volatility. Okay, so if you are doing this one, more or less you are arresting this one.
Yeah.
More or less you are arresting the volatility as well as the time decay. But you never know what is the IV, what is the IV here, what is the theta here, what is the IV here, what is the theta here.
Okay.
And moreover, if you look at the option now, option is always skewed. Okay. At the money, if you look, actually it will be 200, 200. Say for example.
Correct.
Okay. And if you look at the premium now, the premium will come like 180, 150, 120, like this it will go. But in upside, actually it will decay faster. 170, 140, like that it will go. And the meaning of what I'm saying is the premium in call side is always going like this. In put side, it will be little slow. Yeah. The premium that comes in OTM and all, right? It will be little slow. Okay.
Correct.
So you never know what is the strike price you have to choose. By choosing the 200 points here or 200 points here, you will not pitch the right IV in both the sides.
Okay.
Okay. So for which actually I have a solution. The solution is very simple. Anybody who want to do this, they can do. Say for example, you want to buy a call option, instead of which you can do a call debit spread. You want to buy a put option, you can do the put debit spread. The simple logic is, say for example, here you take it right now, 300 rupees, 300 rupees. I'm doing, this is the at the money premium. You have it in Nifty. Let's assume that. Then you want to go in the money. You want to go out of the money. You want to sell. You want to buy this in the money option. Buy this in the money option. Correct na? You want to sell some OTM call option.
Yes.
Correct na? Correct. The logic is, say for example, you fix a premium. 200 rupees is the premium you want to buy and sell in both the sides. Okay. Let's do, this is OTM call option for 200 rupees. Call is OTM 200 rupees. Put is also 200 rupees. This is call.
Strike price or the premium?
Premium.
Okay, premium.
So this is put. So you take 200 wala call, 200 wala put.
Okay.
Call, both are OTM. So now is both are OTM. This is also both are OTM. Yes. I will give a live example. I will give an example also, you will understand. So 200 rupees call, 200 rupees put. For call debit spread, it is okay to sell this. There is no brain. You go and sell this strike price wherever the 200 rupees is there.
Okay.
Correct na? And for buy only, you never know actually what is the strike price you want to buy. But for which there is a hint in a put. You look at the put where the 200 rupees is, the same strike price you buy this call.
Okay.
So that there's the time decay and IV both are same.
Got it. So, let's say I'm buying 200 rupees ka call. So, at whichever strike price we have 200 rupees premium of the put, that strike price will be buying
The call.
on the call side.
So that your theta is same, your volatility is same in both for both buy and sell.
Got it.
So whatever the decay that is happening will be compensated by here. Whatever the IV change that is happening here, actually that will be compensated by here. Even IV is increasing, decreasing, it is a theta neutral and volatility is neutral strategy.
Got it.
And market is going 10% down, you are going to make a fixed loss.
Right.
Because the debit is the maximum loss.
Right.
Okay. So let's take a live example, not live example, 3 months back example, let's take it. Now let's look at this one. Okay. So we have taken, let's go upside. So we have taken August 2025. Okay. We have taken a first off, a month back, we want to do a bullish view. Okay. So this is the one. And this is the put. You can look at this. This is a put OTM.
Okay.
We are seeing is a put OTM. Okay. And you scroll down. Okay. And this is the one actually we are having at the money right now.
Okay.
This is the ATM. Okay. I set an example of 200. You can take 200 or 100 or 150. It doesn't matter. Okay. So for the time being, what we have to do, simple. 200 wala is the premium we have to fix, or 150 or 100. Okay. If you put a tighter one for, if say for example your target is very near, if you are having a bigger target, then go for 100. Very big target, then 50. So let's do a 200 one. Okay. So this one is the OTM put option. Okay. And this one is OTM call option. Call option is always downside, right? So that is how it is written. Okay. Which one we are going to mark? 200 we are going to mark, right?
Yeah.
So let me write here. Okay. So let me make it a right note. So this one close to 200.
Correct.
Which call option? This is call option and this is OTM.
Right.
Correct, na? So which strike price we are going to do? 24. So sell 24,800 call options we are going to do. This is number one. So we have to buy the call option. One. For which we have to look for the put option. Okay.
Right.
Put option close to 200 rupees. This one. Okay.
208.
And the same strike price we have to do. So look at this one.
24,
so we have to buy 24,400 call option. This price is actually, it is 431. Okay. The sell price is actually 212. So this is buy. So minus 431. Yes or no? And sell is 212. So the total this thing is 9, 1 and 2. The total debit is 219. Correct. The maximum loss is 219.
Yes.
If market goes up, you make profit. If market goes down, you make loss. Market stays in the sideways. You don't make any profit or any loss. That is a key point. In option buying, they wanted to make no profit, no loss. At least if there is no movement in the market, they want to make a no profit, no loss.
Correct.
This strategies will make sure that actually you are not making any loss. If market is not making a move, if volatility is coming down, you are not making any loss. So this is the best way to do a option buy rather than doing a simple plain vanilla buy.
So like if we do the naked option buying, out of 3 cases, in two cases we can lose the money.
Correct.
But if we, instead of that, if we just do the spread or the debit spread, out of the 3 cases, in one we'll make money, in one it will be at the break even, and in the third one we can make the loss. So we're just turning the odds in our favor.
Correct. And the margin is also not high. It may be 80K to 1 lakh. Because if you sell option now, they are asking margin of 3 years.
Right.
So option buy, even you have a, say for example, 50,000, 20,000, 30,000 also you can buy in the money option. But here you need to pay the extra margin. By that way, actually you are getting a better benefit.
Right.
So for a put option, you have to do the reverse. You have to buy the in the money put and you have to sell the OTM call.
Right.
Sorry, OTM put.
OTM put.
OTM put you can straight away and go sell. Say for example, 200 rupees, wherever it is, you can sell. For ITM put only, you need to look at the
call of
OTM call option
OTM call.
200. Then the same strike price you go and buy this
Put.
OTM put.
Yes.
So put debit spread. By this way, actually, you can arrest the volatility, you can arrest the data. So debit spread by default it is considered as an option buy because you have a debit.
Got it.
Yeah.
Got it. All right. And I believe you have taught this the entire concept in much more detail in the course.
Yeah.
Along with the back tested results.
Correct. Along with the back testing is especially for overnight. So this I have said that I have said only in a debit spread strategy. But exact rules, what is the strike price you need to buy, what is the strike price you need to sell, and based on the delta Greek value. I explain everything in a course wherein what is the stop loss you need to put, how you have to trial it. Okay, so what scenario you need to use. Okay, what index, which day, which time, exact rules which can be easily automated. That is what I said in Upsurge.
Noted. All right, sir. This was pretty interesting and definitely a new view towards looking at the option buying. Thank you so much for that, and thank you so much for being here all the way from Chennai. Thanks a lot.
Thank you.
And आपको कैसा लगा ये पूरा का पूरा video? Let us know in the comment section below. And if you want to learn this strategy in so much more detail, so much more depth, along with the backtested results, you can go and check out the course by Sir. The link is in the description, of course. And I will see you in the next such informative content. Till then, keep learning and keep trading with Upsurge. See you guys soon.
Thank you.